Welcome back to All Things Money. My name is David Blain, and during today's show, we're doing a little recap of our outlook for 2011, what's staying the same, what may have changed, where we are so far in the year. As we left the last segment and took a break, we were talking a little bit about currencies. I wanted to mention that we don't think the Eurozone is going to have any sort of meltdown or bigger crisis. We think things are moderating in Europe. In fact, Germany is doing extremely well. Their economy is growing very rapidly, and amongst the developed countries, they are probably the leading growing economy in the world right now. If we look at some of the government bond yields in the Eurozone, we see that in 2008 you had these wide divergences that started happening between the larger countries like Germany and Italy, Spain, Greece, Portugal, and Ireland that started having their problems. And we think that those problems will be contained to those smaller countries and that the larger countries will continue to do well. The Eurozone exports have picked up significantly, as well as the euro, although it's still very weak versus other currencies, has stopped its decline and has started strengthening in 2010, and we think that will continue a little bit. I want to talk a little bit about the secular bears in the Western economies. We use the term secular and cyclical. Secular meaning longer periods of time, 5, 10, 15, 20-year periods. Secular. Cyclical are cycles of the market that are more like a year or two or three. And so when we talk about secular bears, we're talking about countries that are in bear markets for long periods of time. I mean, the U.S. has basically been in a long-term bear market since 2000. 11 years now, the return of the market has essentially been very flat. Japan in a secular bear market, for 20, 25 years. And as we look back in history, countries go through these cycles. Well, right now, basically the entire Western world is in a secular bear market, and the emerging economies are the ones that are in the secular bull market. And so the big question is the U.S., Japan, Germany, are we close to ending this secular bear market? And based on history, I would have to say no, that when you look at the return of the markets historically, this particular bear market has not been severe enough, frankly, that on a real basis, this bear market that started in 2000 is only down, about 2% in real terms, where other time periods in history that's very, very modest compared to what was experienced, say, from 66 to 82 was almost minus 8%. And when we look at the things such as the dividend yield and PE and some of these things, we see that the market is not at a valuation level that existed when we had secular bear market lows previously. Now, this is not to say that the world hasn't changed. This is why we constantly stay updated on what's going on, because things do change. But just looking back in history, we don't feel like the indicators are lining up that this secular bear market for the Western economies is necessarily over. The same thing with the emerging economies. Are these secular bulls close to top? And we would have to say at this point, no, that I don't think so. China has certainly, growth has certainly moderated. Its stock market has moderated, but it's still above trend line. The emerging markets versus the rest of the world, once again, it's moderated significantly, still well above its trend line. The resources sector versus the rest of the world is something we look at. The emerging markets are very resource sector intensive. That trend is still well in place. The Reuters Continuous Commodity Index, which is an index of commodity prices that we follow, is still way above trend. These are four big trends that started back in 2000, 2001. The rise of China stock market, the rise of emerging economies in general, the rise of the resource sector, as well as the rise of commodities themselves. And so these long-term secular trends are still in place, and so we don't think that that it's quite over with. What we're looking for is overconfidence in some of these markets, overexposure to some of these markets, and overvaluation in these markets. On a valuation basis, most of the emerging markets are not yet overvalued. When we look at the market cap of emerging market equity exchange traded funds, is about 13.3% versus the market cap of all ETFs. This is just about right in line with the percentage they are in the world. So if you look at the world and the markets of emerging markets, they're somewhere around 13% of the world market. If you look at the way investors are investing using ETFs as a proxy, it's about 13%. So what you look for is if emerging markets only make up 13% of the world, if there's 25% of the investment dollars in ETFs put into emerging markets, that would signal that people are way overexposed to emerging markets, and it would make us a little bit nervous. So we're not seeing those signs just yet. The world market cap of the emerging economies continues to take away market share from the developed countries. If we look at the difference from 2003, we see that the developed countries have lost about 12 percentage points. They've gone from about 80% of the world stock market all the way down to just under 68% of the world market. So that's kind of a recap of where we see 2011. Nothing's really changed from our global outlook that we did at the beginning of the year. Just a lot of things going on in Egypt, Libya. So far, they have not spilled over into our outlook. So we're still overweight stocks. Stay exposed to the global bull market. It seems to be continuing. Recognize that there are significant risks of a peak as we enter into the mid-year. We're watching the market itself. We're watching interest rates. We're watching valuations. As those start to deteriorate, we will probably become much more conservative and allocate our assets more defensively if the cyclical bear market does in fact develop. Okay, well that's about all the time we have for today's show. I hope you enjoyed listening, and we'll look for you again next week. For All Things Money, this is David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.